Hey everyone, how's it going? Hope you guys had a great Monday. I'll take a look at how everything went, but before we get started, I do like to remind you that if you like to join me on Telegram, I send out all sorts of stuff during the day when I can. You can do that by going to
Hey everyone, how's it going? Hope you
tradingpub.com.
guys had a great Monday.
And sorry about that, my speaker, feedback on my speaker. But the other thing that I do need to remind everyone is, yes, unfortunately, we live in a world where there are scammers and we have AI. There are people using my face, my video likeness, my voice to try to convince you to send them crypto, send them money. Never, never, ever do that. The only time that you're anything that is official with me, you will be at an official pay window, or you'll call in to the trading pub in order to sign up for one of my programs. I will never offer to trade anything for you. I will never take your money and promise you returns. I don't do anything like that. I publish market analysis and I publish buy and sell alerts. That's it. I will never trade your money for you and I will never promise you a return. So please watch out for those scam artists and be very, very, very careful. Even if it looks like me and it sounds like me, there's AI out there that is pretending to be me. Well, on a happier note, some of you have asked if I could do this in 1080p, and I'm here happy to announce that we're close to it. Hopefully by tomorrow, I should be able to do 1080p. I just need to do some testing to make sure it all works. So hopefully tomorrow, you'll be able to watch this in 1080p. So let's take a look at SPY on a daily basis. You can see that we didn't really move all that much. We're down 0.03%. We did make yet another all-time high. Obviously, we sold off of that, but we didn't move that much. The low is not that low. The high is not that high. We are still kind of trapped in this very limited range movement. Hey, Spider Monkey. Tim, keys to health. Good to see you. Hi, John. Great to see you all. We're low volatility right now. However, this week there's a lot of stuff going on, and we do have a lot of potential to become suddenly a lot more volatile. So we do definitely want to take a careful look at our volatility regime. Let's take a quick look at what all of those catalysts might be. We take a look at our economic calendar. And what we'll see is that tomorrow we've got the FOMC meeting beginning. That's not going to introduce too much volatility. That's going to be more on Wednesday when they actually make their announcement. But tomorrow we do have some inventories. We have a home price, Case-Shiller home price. That used to be a lot more important than it is now. What's going to be really important here is the consumer confidence and to a certain extent, the JOLTS report. So that can introduce some volatility right here, right around 7 tomorrow. Then on Wednesday, the big event is the FOMC announcement, but even more important than that is when Powell starts to speak. I'm sure someone's going to ask him about being fired, being under investigation, and I'm sure he's not going to want to really answer that question. But we also have the GDP, that's going to be pretty big. Then we've got ADP employment report. I wouldn't put too much faith in ADP report these days. It's been way off the official. Now, one could argue that one might be manipulated or the other, but it doesn't matter. Right? So we don't care about the conspiracy theory stuff. We don't conspire what might not happen. All we care about is the market going to react to it? So the market may react to the ADP to a small extent, but the much more important one is the employment situation on Friday. So we got potential volatility because of that. We got some PMI and ISM over there, some construction spending, some more consumer sentiment, but employment situation is going to be more important over here. The consumer confidence is going to be more important than the consumer sentiment over here. And we will have jobless claims. We have a lot of job stuff this week. Now, on top of all of that, we also have a whole slew of earnings. So if we go over to finviz.com, that's my preferred way. I do pay for FinViz so I can get a more detailed screener. But there's a lot of ways that you can look for earnings. And this is just a great, the convenience of having a screener is, for me, is for now worth paying for. So I can just say this week, I think you can do this on the free version also. This week, I think, is available. So you can see that there's 40 pages. So that's up to about 800 that are reporting. And then, of course, a lot of them are very small and we won't care about, but there's plenty of really big ones, several in the Mag 7 that are reporting. We've got Visa, MasterCard, so we've got financials reporting, we've got tech reporting. So this week is really, really big in earnings. You could have all sorts of volatility. So you just want to be very careful, especially with correlation, because you may not realize that you're in a position or you want to trade something that is correlated to something that has earnings. There could be a direct correlation. So like Microsoft is tech. So there's tech will definitely move together with each other. Mag 7 will definitely have an impact on the market. Financials will have an impact on each other. But sometimes there's hidden correlations too. So for example, you have a bunch of tech that reports, and then suddenly you see something that may be a little bit more ambiguous, like Amazon, and you're just like, why is this moving? Or you say, hey, well, why is my cruise line going? Because there's hidden correlation to tech, because it's in the consumer discretionary, because consumer discretionary moves. So there's different layers of correlation. It can be very tough to navigate during the earnings season. So just understand that there is going to be, or very likely going to be, heightened volatility overall in all the markets and individual names. When you have high volatility, but not necessarily directionality, you could get directionality, but you have high volatility independent of directionality. What it means is you got to be very careful with stops, because a stop can be hit and it can go right back. That's the nature of volatility. It goes up and down a whole lot. So I personally would not be looking at stops. I tend to, during times like these, I personally tend to just remove all my stop levels and just evaluate each situation as it comes. And then targets, if you have directionality, you can hang on to things for longer, but the volatility means that you might experience a large price swing in the near term. So you may just want to grab profits because it might swing just right back, and you may or may not get directionality with that volatility. So quick to take profits, slow to take those stop losses. I know that's the opposite of what people say all the time, but that's the nature of volatility. I'm really emphasizing in these post-market analyses to understand the volatility regime that you're in, because the volatility absolutely should dictate your behavior as a trader, and most people completely ignore it. There's a reason why the huge institutions, the insurance companies, the retirement funds of the world, they don't trade when VIX is above 20. They just don't. They'll just sit on their hands because of that volatility. So why, if they're doing that, then if they modify their behavior, should we not modify our behavior? We can't trade every market the same way. So we do want to take a look at that, be aware that volatility is likely. And what we saw today is basically a very flat market, down 0.03%. And so let's take a look at what VIX did. Right? VIX 15.03. So it looks like VIX didn't do much, up a little bit. But you can see it went as high as 1554. So we are starting to see VIX move, but not a huge amount so far. So VIX might expand. It might expand this week. And again, all of the triggers, all the catalysts this week, especially earnings, could be a reason or the catalyst that we need if we're going to have a pullback or if we're just going to go higher. However, the chances of pullback is less independent of dismal earnings. So far, their earnings have been pretty good. And so this keeps on floating higher. But if we start getting really, really bad earnings, then yeah, we could pull back. Right now, this market is so strong and it just keeps shrugging off things. And then now we're starting to get positive news about certain tariffs deals being signed or about to be signed, or at least the terms have been agreed upon, but we haven't signed yet. And the market, obviously isn't flying higher, but it is leaning positive. So if we get a pullback, we could get a pullback to the EMA 8, maybe the EMA 20. That's a little bit less likely now than before. That 3 to 5% even is less likely than it was before. So let's take a look. If we go from right now, or pretty close to right now, down to the EMA 8, that's nothing, 0.7%. If you go to EMA 20, 1.83%, we'll just call it 2%. Okay, so very, very, very mild. To get to 3%, we've got to go almost all the way, or about halfway to the, I guess, between the EMA 20 and the MA 50. And to get all the way to the MA 50, that's almost 5%. So 3 to 5% is now a lot less likely than it was a couple weeks ago, than it was last week. Now it's looking pretty strong. So pull back to the EMA 8, EMA 20, that's what I'm going to be looking for. However, that volatility, that VIX, could still spike up a little bit. Maybe not all the way to 25 or 30 or 35 or 40, but we might get above 20. We might get as high as 25. Probably, as far as we can tell right now, unless earnings becomes really bad or there's another weird, Powell says something weird, then we're probably going to stay below 30 on VIX. But we are about to enter a week where volatility can spike up a little bit. So if you have a VIX hedge, you're probably, I would consider taking profits on that if you get profits on it, because it's a hedge. We're not expecting profits on it, but if you get profits on it, you could take profits on it, unless we see a marked decrease in sell-off in the market. So far, we have no signs of that. Again, with all the catalysts that are coming up, it is a possibility, but not a huge probability at this point in time. Of course, that could change, right? With more data, we have more information, and then the probabilities shift and adjust. So based on the information that we have at hand right now, 2 to 3%, 1 to 3%, I would say pullback is the most likely scenario. Okay. So let's see. Finviz is great. I missed today morning payouts. Spread good for tomorrow or wait until the next signal? So in the morning payout program, again, I'm only talking very general because in a public forum, I'm not going to talk about specific trades. And I don't want to take too much time away from the education and the market analyses. Morning payout, if you try to trade in the morning, then you're going to create a day trade. That may or may not mean anything to you. But in general, we've already experienced 3 to 7% gain by the time the morning opens. Sometimes we experience the entire gain that we're looking for. So personally, I would never take a morning payout trade in the morning. I would always trade it in the afternoon, never in the morning. Yeah. You make your own decision though. I can't give financial advice. I can only issue trades and in public forums talk about trades, okay? In a very general way. So I can't say things with your specific situation without violating advising rules. Okay, I was so anticipating a stronger pullback today, but it wasn't happening with tariff news. Yeah. That would be buying calls at tomorrow VIX price. I didn't understand entirely the comment, Richard, but VIX is poised to, it can't stay super low forever. Does it mean it's going to happen tomorrow? Does it mean it's going to happen this week? Not necessarily, but I mean, there are signs that VIX could increase this week, especially with all the news and all the catalysts that we have. Okay. I have to leave early. All right, great. Yeah, enjoy your day, John. Enjoy your day and enjoy your Bible study. I'm new. That was the reason for the question. Okay, yeah, no problem, no problem. Again, I have to speak very generally without, so I can't cross over onto advising lines. Yeah, and I'm also happy if you have specific questions that I am allowed to answer without being considered advising, then you can email them to me also. I'm happy to answer more details in email. When you said we can hedge the expected volatility, we can do that by buying call. Yes, that's correct. That's correct, Richard. Yes. Okay. So let's take a quick look at VIX. So if we move up, the question is, do we move up beyond 20? Or, because if we don't, then we're still in the same volatility regime. If we move up beyond 20, do we just stay there for 1 or 2 days, 3 or 4 days, or do we stay there for an extended period of time? So if it's just a quick move upward, then it's not going to be much of a pullback. It'll be that 1 to 3%. If we even if we stay there for a few days, then that would be more like the 3% down to the EMA 20. And then if we stand there, if we do this, then we can expect a deeper pullback. But right now, that's not looking super likely, and that's why I said if you happen to make money on a VIX hedge, then you may consider taking profits early, or your hedge isn't there to make you money, it's to protect you against losses. So if it's just a quick little thing up and down and then we're going up again, then just take a loss on the hedge. You don't have to try to chase profits on your hedge. The hedge is there. If we break down below the EMA 20, we go down to the MA 50, or we break below the MA 50 on the SPY and happen to go down to the MA 200, which at this point in time seems low probability, but that's what your hedge is for, just in case. Okay, so I wouldn't be super gung-ho about trying to make a profit, or my VIX hedge is profitable, let me grab profits. Well, what if it's a deeper pullback and you just got rid of your protection? Okay, so don't try to chase profits on your hedge. Your hedge is there for a reason. It's to protect against something that you don't foresee, that you don't perceive to be a high likelihood event, but you know that there's a possibility there, a non-zero possibility, and probably significantly higher than non-zero possibility, just not over 50%. That's why you put your hedge in place, because just in case, especially if my portfolio is all leaning super bullish, because we are at all-time highs repeatedly, and this keeps on going higher, there's a reasonably good chance that maybe all your positions or a significant number of your positions are also bullish leaning. That's why you have your hedge. Okay, so that volatility regime, I am for the most part expecting it to stay below 20, maybe a spike above 20 for a single day or for a few days like this, nothing huge or major. So if we look at this time period, June 13th to the 23rd, okay, that was this. This is very, very slow, mild pullback to the EMA 20, then bounce, okay? So that's what we're talking about. We spend a few days above the 20 VIX, mild pullback to the EMA 20 and bounce. If we start to see something like this, okay, that's deeper. Okay. Even this, if it spikes way up, even if it comes right down, so if we say December 18th, I think that was the big spike. Okay, so that was a more extreme move. Okay, but if we just poke our head above 20, go to stay below 25, we start at 20, 21, 22, 23 for a few days, and then come back down, that's just a pullback most likely to to or near the EMA 20. Okay, so if we see that, then that means the trend would still be intact, and we come back down into our low volatility regime. That's a bounce off the EMA 20. That is an excellent place to enter new longs, right? So buy the dip, right? Pullback opportunities in the low volatility environment. So that's what we're waiting for. It's hard to get long right here when we keep on making all-time highs, because the pullback pulls back and then you end up in a losing position. So we never want to chase things higher. We want to find our high probability event, our high probability trade, rather than, yeah, we could follow trend higher and higher and higher and higher. But if there are signs of an imminent pullback, then you just be patient, just wait. So don't be in a rush. It does seem like this week, with all the news and out of catalysts, there's a decent chance that we could pull back at the very least to the EMA 8, and that would be a better entry than try to go in right now. Okay, so let's take a look at our sectors and see how that's playing out. Sorry for that bell, guys. Where are my sectors? Interesting. Okay, let's find sectors. Okay, so today we see that there's interest back into tech, SMH in particular, some interest in energy and commodities, but we've got XLK right here, we've got cloud computing, definitely tech leading. That is bullish, but then we got to be super careful because a lot of companies are reporting, so we got to take that with a grain of salt. We've got, on a 1 week basis, wood is staying up here, building products is staying up here. So what we were saying about PAVE last week and like this infrastructure stuff, that so far is sticking onto a 1 week basis. And we want to see if it can eventually get onto a 1 month basis. But if we see pullback opportunities in those sectors or those subsectors, then those are going to represent some really good opportunities. In the meantime, on the longer time frames, we still see uranium and nuclear. We see mining. That's mostly that MP ticker, so I'm not super interested in mining. That's a single event. And then block. So I'd be more interested here in block, SMH, since we seem to be seeing renewed interest in that. And then I would be interested in nuclear and uranium if there's a pullback. So if we look at URA, that is a pullback to the EMA 8, a little bit ahead of the market. And you can see that this is way stronger than the S&P 500 because we are significantly higher than the previous all-time highs. Whereas in the S&P 500, we are higher for sure, but not nearly as high as the URA is above the previous highs. So URA on a pullback to the EMA 8, if this proves to be a bounce, right now, yes, it pulled back to the EMA 8, but hasn't bounced from it yet. So if you try to go in right now, that's early, that's anticipation, that's predicting, rather than watching it bounce and then go for an entry. So I'd be paying attention to this. Excuse me. This week, I'll be paying attention to URA and related stocks. And then what did we say, SMH? SMH, there we go. You can see right there, that curve. So my favorite thing to talk about in the post-market, long-term trend, longer-term trend, I should say, not necessarily long-term trend, but longer-term trend. Then we have a shorter-term trend as represented by the EMA 8. Oops. Come on. Let me redo that. I have the wrong tool, that's why. Up, flat, and then curving up today. So that is early entry. I want to switch from the long term or short term to match the long term. Okay. If we weren't imminently thinking that there could be a pullback in the markets, well, this SMH is ahead. So it could remain strong, but we may want to wait a day or two, or maybe get above these highs right here. So do we break out to a new all-time high before we go long SMH? But definitely a sector that I'm interested in. So we've got the URA SMH that we're looking at. And I thought there was one more. No, I guess tech in general, but specifically SMH. Yeah. Let's see what. We need confirmation of that bounce. That's correct. Okay, but this SMH is already giving us that confirmation. We just have to be careful of earnings. It's going to be hard to go through that list of 40. That's another reason why, especially during earnings season, FinViz, I can download a spreadsheet and then I can comb through and I can filter for which ones are, for example, chips, and then we can know whether or not I need to avoid certain days or certain entries. So we have right here QCOM and ARM that are being labeled as semiconductors, as the top 20 of market cap stocks that are reporting this week. So yeah, it seems like we should be careful. We don't want to be super gung-ho and try to just load up on opportunities, and especially in an environment where we're expecting volatility to at least increase a little bit, because then we can't place our stop without being uncomfortable that we could be stopped out randomly because of that heightened volatility. And so it's just better to sit on our hands for a little bit. Just be patient, wait for the really prime opportunities to come to us, which may mean we don't trade this week. That's a possibility. But if you want the highest probability trades, then that's how you play it. If you don't care about high probability, or you're okay losing a higher percentage of time, 40, 50, 60%, so maybe sometimes even 70%, you're okay with losing that in order to capture a large opportunity. And when you lose small. When you win big, so big that it makes up for the higher percentage of losses. Then yeah, you can anticipate. You just got to make sure that you structure that reward risk correctly. Otherwise, it's an easy way to just, oh my God, I lost so much on these losing trades because I keep on losing. Okay, so you just have to play that reward risk very, very carefully. Okay, so let me take a look at our momentum. It's going to be less meaningful in the light of earnings. Okay, so we need to understand the hierarchy of things that are affecting the market right now, or that affect a market at any given moment in time. So a lot of people just like looking at technicals. Why? Because there's a line here, it's easy, I can always see it. And they'll ignore other forces, which is always a huge mistake. We always want to see the technicals in the context of everything. And that's why last week when we were talking about the trading plan, I said technicals are excellent for timing, but you might want to be careful about using technicals just as your trade idea. Like, oh, the reversion of the short term to long term, that's my trade idea, and therefore I'm going to trade it. Okay, but if you ignore the fact that we're heavily in earnings week and the FOMC and all of that, that can easily erase the edge that you get from a technical. Okay, so we need to know the hierarchy of things. Earnings can erase the edge of technicals. So anything that spikes up volatility erases the edge of a technical. So that means news, that means earnings, which is a form of news, that means data like economic reports, FOMC announcements, anything that has the potential to introduce volatility erases your edge on the technicals. Not forever, but on the day of or within a couple days of, yes, that those forces are going to overpower the technicals. You just might as well not even have that technical setup, because that volatility will just blow through and cause weird and different movement, just like we saw on NEM. Okay, right here, beautiful technical pattern. News completely destroyed it. It only had 4 days of lasting effect, and bam, it just flies up again, and then the technical pattern resumes. So we will always want to be aware of what can override something and how long you can override it. So the way sometimes I like to think about it is the technical pattern that I saw right here, that's like gravity. It's in effect, it's working. But if I'm an airplane and if I got my engines running and I'm going at speed, then I have the law of lift counteracting the law of gravity temporarily. But once those engines power down, gravity is going to take over again and pull that airplane back down to the ground. So once the news event wears off and its power diminishes, then that technical will resume. But are you going to suffer this loss in the meantime? And can you take it? And were you prepared for it? And if you set a stop loss, remember what I said, stop losses get blown out in volatility events. But you didn't know this volatility event was going to come. It's just blindsided by news. So there's no way that I can say, oh, I should remove my stop loss right now, because you don't know that that news is coming. But it's different this week. We know a whole bunch of catalysts are coming. We know that volatility has a high potential of spiking. And so we remove that stop loss and we set lower targets. Okay. Hopefully that all makes sense to you guys. Okay. So I can look at things like momentum and breadth, right, like we normally do. But again, volatility will destroy a study like that. And so it's a lot less meaningful than it normally is for me to take a look at all of these. Those earnings volatilities are going to take over. The volatility from FOMC is going to take over temporarily for a day, for 2 days, for 3 days, maybe even 4 days. And unless the news is so huge that it fundamentally changes the outlook, the future projections that Wall Street has for a stock, then that'll wear off and go away. If we change something fundamentally, if it changes the value, then the future value projections, then it'll be more lasting. Okay, but for the most part, no. Earnings, though, what earnings directly affect future value of a stock. So earnings events could completely destroy a trend like this. So what's Microsoft? Beautiful, beautiful trend. But if it has terrible earnings, it could easily be destroyed. Why? Because that is fundamental. Like, future value is directly impacted by earnings. It is one of the things that is used and heavily emphasized in the calculation of future value. So yeah, that it does have the potential to completely destroy all technicals and completely destroy all trends. And so we have to be very careful around earnings events. Now, let me see, I wonder if anything reported in the last week. Let me see. I think I can do that on FinViz also last week. I want to see if I can find a nice example of that. Previous week. There we go. And let's go by market cap. Google, Tesla, SAP, Coca-Cola. No. Sort of. You can say this is a very, very mild bull or sideways trend. Earnings popped that down, broke below the MA200, and now it's looking like we could be at the resumption, a beginning of a downtrend. Okay, so maybe Coca-Cola, no, just continue to chop side. I'll see if I can get a clearer example of that. T-Mobile, PM, IBM, T-Mobile. Again, maybe if this bounces, but PM. Okay, this is a reasonably good example. Medium or longer term trend, MA50, before that earnings event, up. We have sideways movement right here in the shorter term. Okay, so our normal technical expectation would be, well, normally we follow the movement of the trend, we chop sideways into it, the higher likelihood direction would be to resume whatever it was doing before the chop sideways. However, we have an earnings event, which is probably why we started chopping sideways, and then positive on earnings, negative on revenue, probably negative on outlook, and bam, suddenly we gap down and we keep on trading even lower. Suddenly this trend is broken. Okay, so earnings do have the power of completely changing the trajectory and destroying a trend or destroying technicals. Normal news, for the most part, only has the power to do that for a couple of days, 2-3 days, and then it'll resume. This is an actual change of course. Okay, it's not just, oh, a couple days and then I'll resume. This changed course, and then we'll see if maybe at the MA150, which I wouldn't expect, I don't use the MA150 for anything except for a place to put my eyes in between, because the MA200 and MA100 get really far apart. So I just have a placeholder just to guide my eyeballs. And then the MA200, maybe we'll trade down there. And if that holds, maybe we'll bounce, but we'll still be in a downtrend regime. And then especially if we break that MA200, then we'll be in a bearish regime in Philip Morris. So we completely destroyed this trend with earnings. Now, COVID was something very fundamental. The fact that COVID dragged on for so long was absolutely fundamental. Okay, but most news doesn't have that power. So it only lasts for a couple of days. Okay, so hopefully this is a good example for you guys. Okay, so yeah, looking at the breadth and all of that is not going to be all that meaningful today. Do I see signs of buying, signs of selling? What I should see, if the institutions are smart, is a lot of sitting on their hands. Okay, so unless you have some junior guy who doesn't know what he's doing and is getting all gung-ho and who's about to get slapped by his risk committee, you are going to see a lot of sitting on the hands. There, like in the heart of earnings season, there's no point in me looking for signs of buying in the general market. Maybe in specific names. Or the caveat to that is, if so many earnings reports are going so well or so terribly, and I have a significant portion of my earnings already reported, like we've reported 50%, 70%, 80% of all companies have reported, and of the companies that have reported, 70, 80% have all been positive, then I'm going to be looking for signs of buying in the broad market. And if it was the other way, then I'd be looking for signs of selling in the broad market. But we're just at the very beginning of earnings season. Not that many companies have reported yet. Yes, so far, a large percentage of them have reported quite positive earnings, but we just don't have enough of them reported yet. So I'm not going to be looking for signs of buying just yet, except for very specific names that are related to post-earnings. So right now, everything that we normally do in the post-market is going to be made meaningless by earnings, and we do have to see. So this week, most likely what you're going to hear from me for most of the days is sitting on our hands, just waiting to see. The possible exceptions we already showed you, the nuclear and SMH, especially after major earnings reports. If there's signs of buying, then we could potentially go into those. Okay. A lot of good reporting tomorrow. Yes, that's right. Okay, so since we do have to wait for all these catalysts to happen, earnings reports to happen, I'm not going to keep on digging further, because anything we do is going to be taken with a grain of salt and then could be thrown away just a moment later once a single piece of news comes out. So we're going to end it right here and just say, hey, let's be aware of what's happening in the broader context of the market, understand what our behavior should be in order to protect ourselves and preserve our capital, and to put us in a position to take advantage of opportunities as they arise. And we only want the very best opportunities, the highest possibilities in this particular environment, because increasing volatility is the bane of most option strategies. It helps some option strategies, but it is anything beyond a single call or single put, anything with spreads, anything that has more than one leg, generally is going to get hurt by increased volatility. Not all of them, but generally for most part, yes. And then the single option call or put, well, you have the risk of something moving not in your direction. So our single earnings events, FOMC, whatever weird news, then you're taking on that additional risk. So if you're buying, then you're paying up for that volatility anyways. And then so if it goes against you, you lose. But increasing volatility does help in that case. So if you happen to get it correct, then you can make really good money. So you just need to make sure that you're very, very, very confident on your edge and that you're not over allocating, so that if you get it wrong, then it doesn't hurt you too badly. Okay, so that's the type of environment that we're going into this week. Okay, so I'll stop there. Otherwise, I'll risk repeating myself endlessly. So have a wonderful rest of your evening, and I will see you guys tomorrow.